Welcome to the week that was. If you were watching the charts over the last few days, you might have felt that familiar knot in your stomach.
Oh, absolutely.
It looked like a classic risk-off environment with prices struggling and, capital just heading for the exits.
It did. But at the same time, if you were looking at the SEC filings, the corporate boardrooms, the legislative announcements,
You'd think we were in the middle of a historic boom.
that is the core conflict.
Yeah.
That's what we have to decode. And we're calling it the institutional paradox. The market is, well, it's definitely undergoing a sharp, short-term liquidity flush.
A cleansing phase almost.
A cleansing phase, that's a great way to put it. It's this necessary volatility driven by profit-taking after the big run-up. The market has what you might call a Janus phase right now.
Looking both ways.
Exactly. Looking backward at that speculative exuberance, while at the same time looking forward to a radical, highly regulated normalization of this whole asset class.
So, our mission today is to dig into the source material here and dissect these massive capital flows, these unexpected geopolitical shocks, and the deep regulatory shifts.
We have to understand why the surface-level trade layer,
The day-to-day liquidity.
right, why that has gone so aggressively risk-off, while the foundational build layer, the long-term structural commitment has, well, it's never been stronger.
So let's start right where the pain was felt, the charts. The volatility this week was, well, it was dramatic and definitive. That initial rally we saw at the start of the year just stalled hard.
It did.
Right.
And from a technical perspective, what we saw was a clear tactical failure.
Right. The price was rejected, what, 3 separate times near 93,000?
3 times, and critically, it failed to breach that $95,000 gamma wall.
Okay, let's break that down. That $95,000 level wasn't just psychological, was it?
No, not at all. It was a mechanical ceiling. When we talk about a gamma wall, we're talking about a dense concentration of options open interest.
Driven by the market makers.
It's exactly. Driven by market makers who were short calls at that price. So as the asset price got close to $95,000, they were mechanically forced to sell spot holdings to hedge their exposure.
So for you listening, if you don't track options flows daily, this wasn't just retail sellers getting nervous.
Not even close. This was professional market infrastructure actively capping the rally.
An automated selling trigger.
It was a technical headwind. And once that ceiling held, the liquidity drain that followed just confirmed that institutional capital saw that level as the signal.
Time to take profits.
Time to take profits. And the aftermath was severe. The U.S. spot Bitcoin ETF complex saw approximately $1.13 billion in net outflows.
Over just 4 days.
4 consecutive days, yeah.
$1 billion is a massive number. But I have to ask, measured against the total AUM that's flooded into these ETFs, is calling it a neutralization of flows, maybe overstating it.
That's a fair challenge, but the psychology here is just so critical. While it doesn't undo the cumulative assets, that $1.1 billion, it effectively wiped out all the fresh, high-conviction money that came in during that initial January excitement.
So the message was that the early birds were cashing out.
The early ETF buyers were taking profits and reducing what we call high beta exposure, their riskier assets.
And the most jarring signal came from one of the absolute biggest players.
It did. BlackRock's IBIT ETF. It recorded a massive net outflow of about $252 million in a single session.
Wow.
When you see that kind of capitulation from the quote-unquote smart money, it sends a powerful psychological signal. They're reducing risk. It signals a clear shift in the technical posture.
Which has shifted the market from, everyone being eager to buy the dip.
To a place where institutions are now actively selling the rip. We've lost that $92,000 pivot point we had been watching so closely.
The focus now is entirely defensive.
Completely. For the patient, long-term allocator, the critical line in the sand is that $89,200 to $90,000 zone.
And that's supported by the 50-day moving average.
It is, which measures that intermediate-term trend. A daily close below that would signal a major trend reversal and probably trigger a whole cascade of algorithmic selling.
But the good news here is that the price only corrected about 6% despite that huge outflow.
Which confirms there is high-conviction buying happening at these levels. Someone is accumulating.
Okay, so we've established the tactical liquidity drain. But let's shift from those short-term flows to geopolitical shocks, because this week, an unexpected global catalyst really redefined scarcity.
This was the sovereign dislocation caused by the whole Venezuela situation.
Right.
Intelligence surfaced suggesting the Venezuelan regime held somewhere between 600,000 and 660,000 BTC.
Which is over $56 billion. That would make them one of the largest single holders in the world.
Potentially, yes.
So wait, if the market learns about a massive state-level hoard, this potential supply bomb that could be dumped at any moment, why did the market rally on the news at first? Logically, that sounds terrifying.
This is the Venezuela premium at play, and it's a crucial insight into how institutional players model risk.
Okay.
The market realized these assets would not be dumped immediately. If the U.S. government seizes control of those keys,
As part of an enforcement action.
right, then those assets are guaranteed to be frozen. And not just for a little while, but for years, because of all the complex, drawn-out international litigation and forfeiture procedures.
So the market didn't see a future seller. It saw a long-term lockup forced by geopolitics.
Precisely. This unintended lockup effectively removed about 3% of the total circulating supply from the readily available market float. It is a guaranteed supply shock.
So that overhang of potential dark selling pressure just vanished.
It transitioned instantly into a long-term institutional lockup. So it tightened the available float just as all this new institutional demand from the ETFs is trying to get in.
A geopolitical crisis, paradoxically, created more scarcity.
Exactly.
So if that geopolitical shock locked up supply, that tighter float makes the institutional appetite we're seeing even more aggressive.
It does.
Let's look at that structural build layer, the part of the market that, frankly, does not care about $1.1 billion in tactical ETF profit-taking.
And that commitment from traditional finance, from TradFi, is moving past simply selling ETFs.
It's moving from distribution into manufacturing.
That's a perfect way to put it. We saw a huge crossing of the Rubicon with Morgan Stanley's S1 filing. They're creating proprietary in-house Bitcoin and, significantly, Solana trusts.
That's enormous. So Morgan Stanley is moving to capture the entire crypto value chain. But why Solana? Does this suggest a new, officially sanctioned risk model?
It absolutely does. By creating proprietary trusts for both, Morgan Stanley has effectively elevated SOL to an institutional-grade commodity in their internal modeling.
It's a stamp of approval.
A definitive one. It signals that the firm views the crypto space not just as a single asset treasury play, but as a diverse ecosystem with other productive assets that meet the bar for their sophisticated clients.
And that appetite is now being systematically unlocked for, mainstream wealth management.
Correct. We saw a pivotal policy shift at Bank of America's Merrill Lynch division.
They're allowing advisors to actually recommend allocations now.
Exactly. They can now recommend a 1 to 4% allocation to Bitcoin ETFs for client portfolios. Before, it was mostly just executing unsolicited client orders. This is a game changer. It unlocks vast pools of capital.
Meanwhile, the whole corporate treasury strategy received really existential validation from a key global index provider.
This was the crucial MSCI decision. They rejected a proposal to exclude digital asset treasury companies, DATCOs.
Companies like MicroStrategy.
Right. Exclude them from their global equity indices. This prevented an estimated $10 billion in forced selling from all the massive passive index funds that track MSCI.
So the MSCI ruling essentially confirms that a company holding Bitcoin as a primary treasury asset is now considered a legitimate corporate strategy.
It legitimizes the entire model. The shares of these DATCOs surged on the news. And speaking of which, MicroStrategy just kept on buying.
Of course they did.
Added another 1,286 BTC. Their total is now up to 673,783 BTC.
I have to stop you there because the extreme example here is just fascinating. Hyperscale Data's Bitcoin treasury now exceeds 100% of its market cap.
It does.
Is this just treasury activism taken to its absolute logical extreme?
It is the extreme end of that corporate strategy spectrum, where the primary driver of the equity's value is the digital asset holding. It just illustrates the absolute confidence level in the long-term appreciation of the asset, even if it introduces huge volatility into the stock itself.
This validation is now extending into the core regulatory architecture, starting with what might be the most radical development of the week.
State-level sovereignty over digital cash.
The launch of the Frontier Stable Token, FRNT.
Which is the first sovereign state-issued cryptocurrency in the U.S., coming out of Wyoming, which has long been a regulatory pioneer.
And this is fully backed.
Backed 1-to-1 by U.S. dollars and treasuries. It's managed by the institutional heavyweight Franklin Templeton, and it's deployed on the Solana blockchain.
This feels like a seismic event. Wyoming is creating a state-level instrument that operates outside the Fed's direct digital cash monopoly. Why is that such a massive constitutional challenge?
Because it forces a 10th Amendment legal confrontation.
States' rights.
Exactly.
Yeah.
The 10th Amendment reserves powers not delegated to the federal government to the states. So if Washington tries to ban stablecoins nationally, which is a real debate, they would now be banning a financial instrument issued and managed by a sovereign U.S. state.
It elevates the whole argument.
Drastically. It shifts the political landscape for digital currency legitimacy from a commercial debate to a constitutional dispute.
We also saw this strange normalization of prediction markets this week.
Right, which are starting to be viewed as these surprisingly powerful sources of truth discovery.
And this all follows that weird situation around the Venezuelan news.
Correct. After that suspicious $32,000 bet tied to the Venezuelan seizure, we immediately saw legislation introduced to regulate insider trading in those markets.
So the paradox of regulation is that by regulating it, they legitimize it.
They legitimize the technology. And we're seeing this partnership now between Dow Jones and Polymarket to embed real-time market-implied probabilities directly into financial news feeds.
So they're actually trusting the decentralized market's view of truth over traditional research methods?
Precisely. The financial establishment is admitting that decentralized predictor markets can offer a superior real-time mechanism for truth discovery. They're adopting blockchain data as a primary news source.
And meanwhile, the global rails are also being upgraded. South Korea is signaling approval for spot Bitcoin ETFs.
And here in the U.S., the Senate is preparing for a vote on the crypto market structure bill. Structural clarity, not just acceptance, is what institutions are demanding.
Let's pivot to the ecosystem's periphery, starting with the Bitcoin miners, who are showing a pretty sharp divergence in their strategies, a real mining split.
This is a critical view into the operational maturity of the sector. The high-cost operators are running for the exits, or pivoting.
Like Riot platforms.
Right. Riot sold 1,818 BTC. That's nearly 4 times its monthly production.
To fund a pivot into AI and high-performance computing.
They are liquidating the asset to chase a perceived higher margin revenue stream. And that liquidation, of course, put immediate selling pressure on the market.
And you contrast that with the more efficient miners.
Exactly. You contrast that with highly efficient, low-cost operators like CleanSpark and HIV Digital Technologies, which just reported a 197% year-over-year production increase.
The trend is clear.
Inefficient miners are using Bitcoin as an ATM, while the best operators are doubling down on core efficiency and consolidating the market.
Moving beyond the miners, we're also seeing the institutionalization of yield, which kind of confirms that productive asset thesis we've talked about.
This is significant, right? We saw Sharplink Gaming deploy $170 million in ETH onto the Linea Layer 2 network.
To generate yield.
To generate yield via staking and restaking. This is no longer some niche DeFi thing. This is a public company actively chasing crypto-native returns to offset its operational costs.
And the quiet adoption just continues, turning crypto into core payment rails.
Bypassing traditional banks entirely. Sony Bank announced plans for a USD-pegged stablecoin for the PlayStation ecosystem.
And Rumble integrated a non-custodial wallet with Tether for creator payments.
When massive corporations begin bypassing traditional banking rails to leverage stablecoin efficiency, the institutional foundation is deeply set. It's an infrastructural preference now.
But we should end on a note of caution, because the operational and regulatory risks are still very real.
Absolutely. Despite the maturity, risks persist. The TrueBit protocol suffered a $26.5 million exploit
Due to legacy code risk.
from an old, unaudited contract. And furthermore, a new Chainalysis report highlighted a crucial shift. The primary driver of illicit volume is no longer simple retail scams.
It's sanctions evasion by state regimes.
Sanctions evasion by regimes like Russia and North Korea.
So crime in the blockchain is shifting from simple fraud to acts of statecraft. You're talking about the militarization of the blockchain.
That is a key observation. And this militarization guarantees an aggressive regulatory response focusing on taint analysis and transaction tracing in the coming year. It's a fundamental shift in the security landscape. So to summarize this extraordinary week that was, the market is messy right now because the short-term liquidity layer, the trade layer, is actively checking out. We saw that in the $1.1 billion in outflows.
But the build layer is reinforcing the foundation with concrete.
Exactly. You have MSCI validating corporate treasuries, Morgan Stanley launching proprietary products, Wyoming challenging the Fed with a sovereign stablecoin. The turbulence you're seeing, It's not condemnation. It is simply construction noise.
So the key observation for you, the patient capital allocator, is that this price compression is a tactical liquidity event happening inside a confirmed secular uptrend. The market's flushing the speculators.
Flushing the speculators and the high beta profit takers. Patient capital is viewing this current $89,200 to $90,000 zone as a high conviction accumulation window.
And here is a final provocative thought for you to consider as this week concludes. The most consequential battle wasn't fought in the trading pits, but in the halls of government. If stablecoins can be issued and backed by sovereign U.S. states like Wyoming, asserting their 10th Amendment rights over digital cash, what fundamental limit remains on the adoption of censorship-resistant digital currency within the American economic system? Something to think about as the foundation is cemented.